Okay, so you want to own a bank. It sounds like the perfect business. People walk in and hand you their money. You lend it to someone else at a higher rate. You keep the difference. You get rich while you sleep. That is roughly what a bank does. The problem is what it costs to get there. What happens when the math flips against you? And why some of the smartest people in finance have watched banks they spent decades building die in a single afternoon. So let us start with the most basic question. What a bank actually is. Most people picture a bank as a very secure storage room. You bring your money, they guard it, you take it out later. That is not a bank. That is a locker. A bank is a machine that turns other people's money into income-producing assets. The moment your deposit arrives, it goes to work. A bakery turns flour into bread. A bank turns your deposits into loans, bonds, and investments that generate income every single day. The raw material is other people's money. The product is credit. And here is what makes banking different from almost any other business on the planet. When the bakery sells the bread, the flour is gone. When the bank lends your deposit is still there. You can see it in the app. You can withdraw it tomorrow. And yet most of it has already been lent to someone else. This is not fraud. It is fractional reserve banking. And it is the foundation of every modern economy. You deposit $100. The bank keeps a fraction and lends out the rest, betting that most people will not ask for everything at once. For most of American history, banks had to hold 10% in reserve. So your $100 became $90 of lending, which became a deposit somewhere else, which became $81 of lending. And on, until the original 100 was circulating through the economy as nearly 1,000. In March of 2020, the Federal Reserve eliminated reserve requirements entirely. Today, no fixed percentage is mandated at all. But the core idea has not changed. Banking runs on one assumption. Not everyone asks for their money back at the same time. When that assumption breaks, everything breaks with it. So you want to start one. What does it cost? Before you take a single deposit, you will spend between $2 and $30 million and 1 to 3 years filling out paperwork. You need a charter, federal or state. You need deposit insurance from the FDIC. Both applications demand your business plan, your management team, your risk framework, and proof that your bank has a realistic chance of surviving. The FDIC does not approve institutions it expects to bury. And then there is capital. Capital is not deposits. Deposits are money you owe your customers. Capital is money that belongs to the bank itself. The cushion that absorbs losses. For a small community bank, regulators want roughly a 9 to 10% leverage ratio. In practice, if you want to make $100 million in loans, you show up with $10 to $15 million of your own money. It cannot be borrowed. It cannot come from deposits. It has to be yours. We have not made a single loan yet, and we have already spent a fortune just to obtain permission to exist. Now you are open, and the costs are only beginning. You need loan officers, compliance officers, risk managers, IT staff, cybersecurity teams, auditors. Even a small bank's payroll runs into millions a year. Banking is one of the most technology-intensive and most heavily regulated industries on earth. Anti-money laundering rules, fair lending laws, stress tests, quarterly reports to multiple agencies. And then there are the bad loans. Some borrowers will not pay you back. Ever. Banks must set money aside in advance for those losses, and in bad years, those provisions devour what would have been profit. So how does the money actually come in? The engine is the net interest margin. You borrow cheaply from depositors and lend expensively to borrowers. A savings account pays almost nothing. A mortgage charges 6 to 8%. A credit card charges far more. The bank sits in the middle and collects the spread. On top of that come the fees. Account fees, wire fees, overdraft fees, the interchange fee collected every time a card is swiped, wealth management fees, and for the giants, investment banking. In 2024, JP Chase earned $58 billion in net profit, the largest annual profit in the history of American banking. Not because the spread on any one loan is big, because small percentages multiplied across trillions of dollars become inconceivable sums. And here is the trap hiding inside that number. Almost every other business earns returns on its own money. A bank earns returns on money it does not own. That is leverage, and it cuts both ways. A bank holding $50 billion in deposits on $5 billion of capital only needs to lose $5 billion, 10% of what it owes. Before it is technically dead, The thing that makes banking so profitable is exactly the thing that lets it collapse so fast. Ask Kerry Killinger. He ran Washington Mutual for 17 years and built it into the largest savings bank in America, 2,200 branches, $188 billion in deposits. One had pushed hard into subprime mortgages, and for years, the extra interest more than covered the extra defaults. Then home prices stopped rising. Defaults piled up. And when Lehman Brothers collapsed in September 2008, WAMU's depositors panicked. In 10 days, they pulled out $16.7 billion. Regulators seized the bank and sold it to JP Morgan for $1.9 billion. A bank with $188 billion in deposits sold for less than $2. Or ask Silicon Valley Bank. $209 billion in assets. 40 years of operation. Gone in 44 hours. SVB's sin was not bad loans. It was duration. It had parked a flood of tech deposits in long-term government bonds, the safest asset in the world, right before the Federal Reserve raised rates at the fastest pace in 4 decades. The bonds lost billions in value on paper. When SVB admitted it, the venture capital world found out by group chat. In a single day, customers tried to withdraw $42 billion. The bank did not survive the night. 2 different diseases, the same cause of death. Confidence ran out faster than any capital buffer could move. So let us run your numbers. You raise $15 million, build a $100 million loan book at a 3% margin, add fee income, and gross about $3.7 million a year. Subtract payroll, technology, compliance, insurance, loan loss provisions, rent. You clear roughly $600,000. At that pace, recouping your $15 million takes about 24 years. And that is the good scenario. Let rates rise 2 points while half your loans are locked in, or let a recession triple your defaults and you are losing money every month. 2 bad years consume a quarter of your entire cushion. 3, and the regulators are calling. Banking, when it works, is one of the most profitable businesses in the history of commerce. The great families of Europe chose banks over factories because whoever sits in the middle of money flows collects a toll on everything an economy does. But no industry has produced more spectacular collapses because the bad years do not arrive slowly. They arrive in 10 days. They arrive in 44 hours. They arrive the morning someone sends a message to a group chat. So if you do decide to own a bank, understand what you are actually buying. Not a vault, not a predictable income stream, a machine that turns trust into money and runs entirely on the assumption that the trust never runs out. The moment it does, no capital buffer in the world moves fast enough.